Inflation has printed a couple of soft months. Um, we have seen soft months in the past revert. There's some real questions about whether uh, we're seeing true disinflation or simply or how much of it is being impacted by seasonal measurement issues, which overstated the inflation earlier in the year and maybe understating the inflation this year. We saw a similar pattern happen last year as well. I think the basic question is, you know, given the circumstance where we have inflation that, even with a couple of weak prints is still elevated relative to the Fed's mandate. And we have an environment where, while we're seeing some softening in labor markets, we're not really seeing an acute softening in labor markets. If you look at, for instance, prime age working percentage, so the percent of prime age population that are employed, it's basically at secular highs and has been flat for 18. That's not an environment of that requires swift cuts to be delivered by the Fed. And so while there is certainly some desire from the Fed to normalize in their words, not in mine, to move interest rates down if we get easier inflation on the concern that there might be weaker dynamics in the labor market, it odds are that this whole process is going to move a lot slower than and be bumpier than the sort of straight line expectations that are currently expected in the markets. I mean, just look at what we see here on services ex shelter, which ultimately arbitrage to wages. Services ex shelter, there's lots of details under the hood that in terms of exactly how it gets measured, but at a big picture level, services ex shelter is a function of either input costs like oil prices, basically oil prices and gas prices, or wages. Well, what we've seen is 2 months of extraordinarily low services ex shelter numbers. Notably, we saw the same very, very low set of numbers emerge last summer over the course of the same months, raising the question about whether there's some sort of seasonal issue here. And in a way that, to be frank, is implausible. Uh, this sort of shift from being elevated, from running at 4 or 5 or 6% to running at basically zero over the course of 2 months. That's not how price growth works in the economy. And if you look and triangulate other measures of inflation, core inflation, surveys, consumer expectations, things like that, there's basically been no change over the course of the last year. And so much more likely that what we're seeing here is noise in the data rather than big shifts in the reality. And so you put that together with the fact that wage information continues to suggest that wage growth will remain elevated in comparison to pre-COVID levels, and where we're seeing productivity continue to be mediocre, productivity growth to be mediocre at best. These numbers are through the first quarter. The second quarter is going to basically be the same: 1.5% growth, 1.5% employment growth. That's 0% productivity. An environment where we're seeing wage growth, say ECI, at 4 to 5%, and at the same time we're seeing zero productivity growth. That combination is not a combination that's going to lead to a significant wage disinflation. While some numbers have come down, things like average hourly earnings, many of those numbers have composition issues, and they're more reflective of the shifting composition of incremental employment than they are a reflection of the shifts in overall wages. Big picture is wage growth is growing a couple points higher where we were pre-COVID, and productivity growth is growing weaker than where we were pre-COVID.